Let's start with the gold prices, and those have declined quite sharply in last 24 hours, trading at lowest since the month of June. That's a 6-month lows coming in for the prices. We did see a brief decline below $1,200 per ounce as well, as the Fed took its first step away from the ultra-loose monetary policy that had helped drive bullion prices to record highs in recent years. The Fed said that the U.S. economy was finally strong enough for it to start scaling back the massive bond buying scheme, winding down the era of easy money that saw the gold prices rally to $19-20 per ounce in 2011. The Brent prices also are holding steady at over above 109 a barrel as the market shrugged off a move by the US Fed to reduce its monetary stimulus program. And the focus actually remains on the US crude stock draws. On your screen, very flat trades coming in for the crude prices there. Ditto is with the NYMEX as well, very flat trades there as well. Let's bring in on board then Vijay Bhamwani, who's author and CEO of BSPLindia.com. Vijay, hi, welcome. What's your sense, first of all, in the precious metal space? Did you anticipate this kind of a decline, or is it less than what you expected when the tapering would actually happen?
Manisha, good evening. I have been talking about staying away from longs because the levels I've been talking about, 42,500 to 42,800 band on silver, and 28,600 or maybe 28,250 levels on gold were anticipated chartically, and what has happened is the $10 billion a month tapering by the Fed has basically triggered an unwinding of long positions. This was along expected lines, and that is the reason why I've been advocating staying away from leverage space. Even in the delivery space in silver, 42,500 is a level at which there would be some comfort to allocate 10% more into buying delivery investments. Other than that, I think there is scope for further downward price movement, and over a period you're likely to see deleveraging. It's an aspect that I have been pointing out for at least a fortnight. I'm seeing deleveraging, including on industrial commodities as well as bullion. There will be sporadic buying activity on some counter or the other, but I don't think that bullishness over a period of time, at least in the absolute near term, is likely to sustain.
Vijay, how do you see it going forward from here? Because this is just an announcement of tapering. The actual tapering would only start by Jan 2014. Do you see further volatility continuing into this space, and how much of a further decline would you or are you really factoring in right now?
Manisha, I would not really be surprised to see another 3 to 5% decline in bullion. Ditto with industrial metals. I think 2 to 3% decline in industrial metals is also likely. It may not really occur overnight, but there is a slow slide in the offing, and support will only emerge from bears who are covering their shorts and booking profits rather than any fresh buying emanating at lower levels, because I think there is a clear indication that easy money policy might just be on the wane at this point in time, and therefore people will be, on the contrary, in looking out for opportunities to unwind long positions at higher levels. So upsides are likely to be fairly labored.
We haven't seen much of a reaction coming in for the crude prices though, Vijay. What's your sense coming in for that? Because apart from Fed tapering, there are a whole host of other things as well which are working in for this space. To start with the whole shale gas issue, while we did see the natural gas prices run up quite strongly, up nearly 27% even at this point in 2013. Do you see that kind of a strength continuing, or do you think the Fed tapering, the liquidity coming out of the market is something that could hit this space also?
Manisha, the largest players in the market are the hedge funds, and they are very sensitive to availability of easy money, cheap money. And easy money is basically mother's milk to any bull market. When you basically start to taper off the liquidity flow, you are impacting and curbing the ability of the bulls to build fresh long positions. So I think further downsides are very clearly in the offing. You are talking about energy and natural gas prices. Natural gas is moving up because of the expectation of a harsh winter. So therefore, cyclically speaking, it could see some more further upsides. The 280-82 band I've been talking about for weeks now, that is the kind of level that I'm expecting where selling pressure could emerge. Where crude oil prices are concerned, there is an expectation in the oil traders' circles that the economic outlook having turned favorable, the demand expansion for energy, especially hydrocarbon fuels and WTI crude, will basically see some more speculative premium getting built into it. So I would not be surprised to see 6175, maybe even 6200 levels on MCX. That's where I expect some pockets of resistance emerging at higher levels.
All right, let's get another view as well. And joining us now is Kishore Narne, who's Associate Director, Head Commodities and Currencies at Motilal Oswal. Kishore, hi, welcome to the show. How have you read into the tapering, and what's your reaction or the first sense that you read into the movement that the gold-silver prices have made?
Good evening, Manisha. I think, again, it's been much anticipated, and the quantum has been a little bit debatable. Otherwise, more or less people were discounting tapering in December or Jan. So most of the things are discounted in gold especially. And we've been witnessing some kind of a support at around 1210, 1220 kind of levels on dollar terms. But still, I think the overall downtrend in the entire metal stack, including gold and silver, even platinum kind of things, all the precious metals would continue to fall because a rising interest rate scenario with a tightening of monetary policy would be one of the most disastrous, along with the strengthening dollar. So in dollar terms, there is no doubt that we are going ahead, gradually slipping towards $1,080, $1,100 kind of levels, maybe by mid-2014 or so. But the question is, in domestic markets, how stronger the rupee would be able to withstand the dollar rise. So I think in India it will be a gradual decline, and if there is any removal of import duties, then that could actually impact Indian prices much more than the falling dollar gold prices. So I think, and discounting, let's say, import duty coming back to around 6% by mid-2014. So that would take it to around 27,000 levels, 26,500 kind of levels. So I think that's where medium-term expectations will be landed.
I just want to touch upon on what the international markets are also doing, Kishore. On one side, while there's a Bernanke statement also saying that whatever tapering will be done in a measured tone. Do you think that the surprise element in that sense would be out of the market and you maybe not see so much of a decline in commodities? And two, as the intrinsic thing is in the commodities that they have a cost of production, so how much of a further decline would you really look at? Where do you see a support coming in?
Again, I would not like to tie the whole bunch of commodities into one pair and say that, okay, because the tightening of monetary policy, especially the easy money going out, the entire commodity complex should fall. Again, relevant strengths of commodities have to play out. So I think nickel is going to be a standout performer in 2014, and gold, silver, obviously, as we discussed, will be under pressure. Copper is again having a surplus year. So I think we will gradually return back to the commodity fundamentals than the money chasing commodities. So I think rather than speculative interest, the fundamentals will come into the forefront, and let's say copper going to be a weaker metal in the base metal pack, and probably nickel will be out surpassing, and crude is something which is more relevant to the supply dynamics in the Middle East, especially if the Libya returns back to the production. Probably that's when we can see a good fall in crude prices. Otherwise, again, natural gas being a cyclical commodity, the weather is going to decide. So I don't think the QE3 is going to decide the commodity trends in 2014. It will be more return of fundamentals and the easy money.
That is good to know, because in 2013 the Fed tapering was the big theme that had played out through the year there. But Vijay, as Kishore was pointing out, his best bet perhaps is nickel as he goes into 2014. What are you watching out?
Manisha, I'm focusing more on agricultural commodities. I think in the absolute near term, due to election considerations, there might be a downward pressure on prices. But after April of 2014, my guess is slowly but surely agricultural prices are likely to edge higher. And where hard assets are concerned, the non-agri commodities are concerned, I would like to focus on nickel and aluminium as two dark horses for 2014, provided, of course, the price is right. At this point in time, I think nickel is either sitting on the fence or approaching the upper end of the band, which would be at 920 odd levels. That's where I expect resistance. Having said that, if I do get nickel in the January future series at 828 or sub 828 levels, I'm inclined to buy nickel at those prices.
Let's start with the agro space, where the sugar prices were trading steady today on the hopes that government would give incentives to mills to produce raw sugar for exports, offsetting ample stocks and a pickup in the cane crushing as well. Without the government help, it is difficult for mills to export sugar, as the global prices also are trading depressed at 3.5-year lows there. The India's cabinet meeting, which has just gotten over a few minutes back, has been considering interest-free loans to sugar mills. Worried over slumping prices and rising stocks, the government is also considering giving mills as much as 1.17 billion in interest-free loans. That's about sugar, but the guar seed futures also saw some strength on short covering after 4 days of declines. You have seen chana prices continue to decline on expectations of higher production due to good progress of sowing and favorable weather, while the higher stocks also are weighing. In spices, turmeric futures rose on pickup in local buying with some fresh export inquiries and concerns over the quality of the crop due to excess rains in Andhra Pradesh. Jeera prices also rose on export demand, though the expectations of increased production and higher than expected supplies have restricted upside here as well. Kishore, to you first, what's your sense really coming in for the sugar prices now? Very choppy moves, very politically driven and very news driven as well in the last few sessions.
Yeah, I think on sugar, probably we are gone through various events over the period of a month or so, but still we are finding that 2700, 2750 is being a very rock solid support. So I'm not a bear in sugar at this point of time, but again I'm not a very optimist, and I'm not seeing a significant rally coming up. Probably you can see 100 120 rupees rally coming up in sugar, probably 2820, 2840 could be possible. But beyond that, I'm not seeing a huge rally, because you also know that we are sitting on a huge crop. Which is certainly going to be a dampening on sugar prices. So if I had to sell, probably 2420, 2440, 2840 could be selling levels, but at close to 2700, it would be a buy trade for me.
Just keeping it with sugar, Vijay, what's your levels that you are watching out for? Because we are expecting that news to come anytime. Do you think that could really help the prices? And at these current levels of nearly 1% up ahead of the CCEA meeting today, what's your sense?
Manisha, I would still maintain my view that 2700 or 2725 levels on the median farm month futures are a bankable support. And the prices which are subdued will possibly remain under check till the middle of March, maybe first week of April. Beyond that, I would expect prices, at least in the financial futures markets, which have been subdued, to basically inch towards the 3000 plus levels. So come January, if I was to see February futures available at 2700 or 2720 odd levels, I'm a keen buyer in sugar.
Let's take a look at the chana prices too, and that hasn't done too well in the markets there. The fundamentals, of course, are bearish. Kishore, what's your sense coming in for that space?
I think even chana has been overloaded with supply concerns. So any possibility of a major rally it can be ruled out. So I'm still looking for maybe 100-120 rupees range bound trade. So there are no significant trading opportunities. So it's a range bound move for me.
Vijay, what's your sense in the edible oil space? Because that has been choppy as well, moving with what the rupee has been doing. What's your sense as we start the day tomorrow?
Manisha, I think the rupee might just cushion the decline in crude palm oil. But if the rupee was to appreciate, I would expect CPO to basically settle below the 550 level comfortably, maybe even edge towards 542 to 544 levels. Ditto with refined soya oil. Even there, the overhang of the well-supplied market is likely to play up on market sentiments. The only saving grace, as I said, could be the rupee-dollar parity coupled with crude oil prices. If crude oil was to edge higher, then the biodiesel demand for crude palm oil might just cushion the declines, although that cushioning impact may not really be extremely sizable at all.